Good morning, good evening, good night. We'll be watching this transmission. It is I, Mike Martins, ready to bring another hard-hitting article here. Posted today, sent to me from South Florida, from a good friend of mine down there. Emailed this to me and said, read this on your show. This is a big deal, and I know a few friends that are tangled up in this mess. Credit card alarms get louder as charge-offs hit 7-year high. Write-offs, defaults. Red flags are flying in the credit card industry after a key gauge of bad debt jumped to its highest level in almost 7 years. You guys remember what happened with the anniversary 10 years ago, right? You guys, 10, no, it's been 11 when 2019. It's been 12 years, but you guys remember 2007, 2008 and the whole fiasco. Well, credit card debt took a life of its own. It grew like a mold. And I don't know how people think that having a blended rate is a good thing. Blended rate means you got your auto loan, your Visa, your MasterCard, American Express, and what's that one? What's in your wallet? Capital One. Why do people think or visualize that having a blended rate is good? It's called financial death. And that's a spiral. And I used to know a guy that used to pay a credit card off with another credit card, and then he got another credit card. Yeah. The charge-off rate of percentage of loans companies have decided they'll never collect rose 3.82% for the first time in 3 months of 2019, the highest since the second quarter of 2012. According to the data compiled by Bloomberg Intelligence, and loans 30 days past due, a harbinger of future write-offs, increased at all 7 of the largest U.S. card issuers. There's been a degradation in credit quality for certain customers, according to the Richard Fairbank, Chief Executive Officer of Capital One Financial. What's in your wallet? The country's third largest card issuer, Fairbank, said some customers with negative credit events during the financial crisis are now seeing these problems disappear from the credit card bureau reports. So it takes 7 to 8 years for your credit reports to kind of recover or resuscitate. We may be looking at data that might not paint the full picture of the consumer's credit history, Fairbanks said. Well, it's very simple. I'll tell Fairbanks. You just look on the gaps. Look for gaps on file. That's all. If you see the person's 40 and their credit was established 5 years ago, there's a gap on file. They definitely file for bankruptcy. That's a good thing. That's a good way, a good tool. And then you could skip trace through using inquiries that were made from the past credit bureau to see if they skip trace through applying for more credit in between reestablishing their credit. So there's ways of doing it, okay? We may be looking at that might paint a full picture of the customer's credit history, Fairbanks said on Thursday on a conference call with analysts. Part of the context for our caution has been not only how deep we are in a cycle, but also this is the time period when there is less information that there once was. There is less information? You got to be kidding me. The CIA or whatever you want to call it knows when I'm taking a dump. They know when I'm riding my bike. Capital One said Thursday that this is the first quarter U.S. card charge-off rate that climbed to 5.04%. That is big. 5 points. Completely just right off. Dead loans. Dead lending. Dead. The books. You can wipe that right off the books. Get your eraser and erase that off your any gains you've had from the last month. From 4.68% at the end of 2018 at Discover Financial Services, which also reported results on Thursday. The charge-off rate increased to 3.5% from 3.23% in the prior quarter. Certainly, this has been one of the longest recoveries. So in general, we have been contracting credit policy and the margin and tightening. Discover CEO Roger Hochschild said in an interview, Hochschild said his company has been closing inactive accounts and slowing down the number and size of credit line increases for both and new existing customers. Yeah, guys, listen to me. Like, hear me out. A lot of these people that are taking more debt and taking on more loans need credit counseling. They don't need more debt. They don't need more money. They're consuming off. If they don't get credit card increases, some people don't eat. But then they're paying this VIG. The VIG is a big problem, right? And you got this blended interest rate. You know, the blended interest rates, it's destruction. Oh, we'll just apply it for another credit card. Or our credit score is good. And some people get really smart. They apply for 3 credit cards in a way where it doesn't show an inquiry on the credit bureau until the end of the month when it's updated through Equifax or whatever they use. And some people get really smart in doing that too. I've seen that, where they take 3 inquiries, but they take the 3 inquiries on the same day. So they shotgun call. And then that won't appear as an inquiry, so it doesn't lower their credit score. The industry latest warning builds on develops in January when fourth quarter results showed charge-off rates near the lowest in decades were coming to an end. Competition for the highest quality customer remains fierce, lending many issuers to spend more on marketing and rewards to gain market share with that group. But a growing wariness about the potential for rise in bad debt has led many issuers to tighten underwriting. So yeah, well, you got to tighten your underwriting. These people need credit counseling. But hear me up, okay? A lot now they have these gimmicks that they give you. You get free aero points, free flights, free this. I have a credit card for my company. It's in my corporate account. It's only a $2,000 card, and I pay it off in full after I use it. But I let it sit there for a bit so I can accumulate a few points. I've accumulated enough travel points to go to Colombia 40 times. I'm serious, because I was bringing in huge volume in my department store in downtown Vancouver, and but that was like $60,000 credit card. That was different. But I was bringing in huge volume, right? But I've collected so many points that I could actually get money back as a return, like a money back if I want money back for so many years of doing it, right? But a lot of people think they're getting ahead by taking on more debt, but they're just not. It's the blended rate, right? Growing up in my teenage years and all, growing up into my 20s, we used to call interest VIG. So if you hear me say VIG, oh man, that VIG is too high, dude. Or we used to call it underjuice. Like when you have to pay underjuice to somebody, or VIG, that just means interest. So if you hear me say that once in a while, nobody panic, okay? To be sure, charge-offs remains not far from historic lows as bank benefits from low unemployment rates. In the United States and Capital One on Thursday surged 4 points in New York trading after telling investors that the efficiency ratio, a key profit metric that measures how much it costs to produce a dollar of revenue, would improve to 42% by 2021 as it closes data centers and migrates its system to a cloud computing. If you think about lending products, there are always people that want to take your money, Hochschild said. But the problem is these people don't have money. You see? They're paying as you go, so they don't have money. I can understand they check my bank. Okay, this guy's got $2 million. Okay. Give him a credit card. Let's see how much of that we could take on his VIG or his interest. How much interest we could juice him out of his money. But most of these people don't have the money, so it's a pay-as-you-go system, right? You're going for people who have many choices. They have existing cards. They could get any card they want. So our job is to make sure that those are the ones we attract to Discover. So, wow, Discover cards still exist? Does anyone even take that? Anyways, very important. I wanted to send this out to you guys. I wanted to send this message. I want to thank everyone for joining me on this little tour here. Guys, watch your blended rate, okay? There used to be an app not an app, but like a web page that could calculate your blended rate for you. So what you do is you take like all your credit, anything you're paying VIG or interest on, any VIG you're paying, you take all that, put it into that little sheet, like it used to be a page, and then you put it in and how much percentage you're paying on each card, and then it gives you a blended rate. because you have a revolving debt with that. So there's the revolving debt in some of the credit cards too. So you got to be super duper careful, okay, guys? And I don't give financial advice. I'm not giving any here. I'm just telling you how the credit system works. My advice is to be careful when taking on more debt. My advice is to pay off the smallest debts first and move your way up to the bigger ones, because you're still paying the interest on the small ones still. I'm just trying to help. I'm not giving financial advice. I'm not allowed to give financial advice. I can't even read. Do your due diligence, study, understand how things work, because it's your money and what's in your wallet, like Capital One says. Thanks for joining me, guys. Let me know what you guys think in the comments below. And if you want to support the transmission, please share one of my videos. Thank you.